This is Julia Kempton.
And I'm Shravan Putluri.
And welcome to the EDG Weekly News Update. This week we're going to talk about a story not directly related to development, but one which addresses key themes in international finance and its regulation: the precipitous instability of the storied Swiss bank, Credit Suisse.
Unlike Silicon Valley Bank or Signature Bank, the two US banks which failed in the last few weeks and set off this crisis, Credit Suisse is heavily intertwined with other major international banks. It takes money from and invests in not just a hyper-specific industry with some bonds thrown in for diversification, which was the downfall of SVB, but from and in other banks. If it fails, there are concerns they could too. Credit Suisse is Switzerland's second largest bank.
It is widely used for day-to-day banking in Switzerland. It has branches all over the country and is used by everyday people. But on a global level, the vast majority of its money comes from large deposits by the mega wealthy and associated corporations or hedge funds. A number of scandals in recent years have marred its 167-year-old reputation. In a lot of ways, the secrecy and discretion that made Credit Suisse so desirable are what allowed some of these abuses to take place, a key reason why transparency is so strongly valued at many development-focused banks.
Credit Suisse took on its modern form through a series of mergers, splits, and acquisitions in the 1990s and again in the early 2000s. The bank had faced significant scrutiny and some prosecution in the US over its policies before and during the 2008 financial crisis. Then there was a 2020 scandal about covert surveillance. The same year, it lost $5 billion when Archegos Capital Management defaulted, a private wealth firm Credit Suisse had given extremely risky loans to. In 2021, Credit Suisse paid a $475 million fine in a settlement regarding a fraud case in Mozambique. Indeed, risky decisions were something that defined Credit Suisse's business model, and not always for the better. As such, the bank planned on restructuring and cost-cutting efforts in mid-2022, which proceeded despite a bit of online panic in October 2022 that the bank would fail. A plan to raise $4 billion in the new capital by end of 2022 was successful, leaving Saudi National Bank becoming Credit Suisse's largest shareholder, with nearly 10% of the bank's shares.
But then, on March 14th, Credit Suisse released its 2022 end-of-year report, which found material weaknesses, including withdrawals totaling $120 billion to the end of December 2022, and the fact that, quote, outflows had not yet reversed. Credit Suisse's share prices dropped by 15% in one day. When the Saudi National Bank said it would not buy any more shares on regulatory grounds, they dropped further, especially because of a spokesman's off-the-cuff remark to a reporter asking if Saudi National Bank would invest further in Credit Suisse. Absolutely not, he said. To stop a collapse, the Swiss Central Bank offered Credit Suisse up to $54 billion to shore up funds. Swiss authorities then engineered a deal that would see UBS, Credit Suisse's longtime rival, buy it for $3.2 billion in stock options, assuming up to 5 billion Swiss francs, around $6 billion in losses.
This is a developing story which may change in the coming days, but the rapid decline of Credit Suisse, though not unsurprising considering its long-troubled, high-risk investment culture and the lengths Swiss regulators went to protect it, illustrate the danger of wider instability among lending institutions. I'm sure you've heard a lot about this story in the news this week, but for those of us interested in economic development, it's a reminder that the most basic structures of finance and investment banking can have an impact on everything else.
Thank you. Now, on to the meeting.